Why 1953 specifically?
Yeah, 1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations. And then there's this question of, should I involve some a little premium on top of that, right? The term premium, which is I'm locking my money up for 10 years. I might be wrong in my expectations, and so I should probably be paid for that, at least a little excess over the expectations. And so they're connected. Most of the 10-year rate is an expectation. Those expectations are often wrong, but that's a separate issue. But there is a policy lever, and on the other hand, there's the market lever, which is the term premium, their demand to actually buy the bond in the first place.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species. Kilometers of volume within which
This is Daybreak Asia. We're counting down to Asia's major market opens as we get more confirmation from the FOMC minutes that the Federal Reserve might continue to move higher. Of course, today, though, we might see the first major central bank to actually pause on rate hikes. Heidi, of course, we're talking about South Korea.
Yeah, growth fears from the Bank of Korea, right, as those demographics continue to plunge. We're also, again, worried about this US-China decoupling narrative. A reminder as we hear that China is encouraging their state-owned enterprises not to work with the big four auditing firms, that even if some areas are still up for collaboration, these key areas on data security, on advanced tech is still very much where we're seeing the two part ways. Let's get you straight to the market open now. Beryl, what are you watching?
Thanks, Heidi. Sherry, yeah, we do have the open of South Korea here today. Australia is also 1 hour into the day's trading. Japan, though, shut for a public holiday. So we'll just take a few minutes to see that live pricing start to appear for the Kospi. But in terms of what we're watching today, well, as you said, Sherry, it really comes down to that Bank of Korea decision that could be posted as soon as this hour. The expectation from the vast majority of economists that have been surveyed so far is for the bank to hold rates at 3.5%. That would be the first unchanged decision of the year, but it would reflect as well those two dissenters in the previous decision who had argued that there was a growing economic malaise building in the economy. And we will have those updated GDP and CPI forecasts as well later today. So the start of trading for stocks today, we're actually seeing the Kospi gaining 0.6%, really also being led perhaps by those tech stocks, given we did see Nvidia posting a brighter sales forecast. The decision could come as soon as this hour, but certainly the concern amongst policymakers does appear to be on those growth worries over inflation, capital outflows, but inflation really came through in those Fed meeting minutes. If you change on now, officials very much underscoring their fight to bring down that CPI rate and their resolve as well. That is playing out into the ASX 200, being led lower by energy, material stocks. They're very much in focus, and we are still seeing WTI now just fractionally high here, or steady really, but definitely, Sherry, in its longest losing streak of the year. Again, really down to that hawkish message that has come out on inflation.
Yeah, oil really hasn't lived up to all of those expectations from China's reopening. But let's get more on the early market moves in Asia with Bloomberg's MLive Strategies' Mark Cranfield. Mark, so if we have more confirmation on this narrative that is higher for longer, at least here in the U.S. with the Federal Reserve, but at the same time you have the BOK now potentially pausing, what does that do to the markets, especially the Korean won?
I think in Korea and in Asia in general, we've got used to the idea that central banks are often do their moves in a slightly smaller way than what we get in the G10 complex. So it's clear there's almost a coordinated message among the G10 central banks. We saw from New Zealand yesterday, we saw it in the Fed minutes. They've got a lot more work to do, and they keep on talking about inflation as the main battle that they're having. In Asia, both on the rate cutting cycles and the rate hiking cycles, they tend to be more moderate than you see in the G10. And it wouldn't be a huge surprise if the Bank of Korea takes a pause now. They were one of the early movers in Asia, so they're ahead of the curve in many respects. And obviously their local conditions are somewhat different to what you're seeing in Europe and the United States. So certainly there's good reasons for the Bank of Korea to take a pause. But if they are worried about inflation coming from China's reopening, then they may do a little bit more. It's probably a close run thing here, but they're certainly coming towards the end of their cycle, even though G10 central bankers have made it very clear that there are several more hikes to come in that respect. And the difference between rates in the major countries coming from China's reopening, then they may do a little bit more. And Asia is probably going to widen even further from here.
Mark, does that mean more currency pain ahead, particularly for the likes of the won?
It's probably going to be in an area where it stays relatively weak compared to the US dollar, certainly, probably to the euro. But obviously, it's also very dependent upon what happens with the Chinese currency. So the Chinese currency has been relatively stable recently. So the Korean won will take a certain amount of comfort from that. But you can tell from the Bank of Korea messaging this week, they're watching it very closely. They're prepared to intervene if they see excessive weakness. But they wouldn't mind it staying slightly on the softer side. That's obviously going to help Korean exports, which certainly will need it as the global economy starts to get back on its feet. So they won't be too unhappy if it stays within a range which is on the soft side. But as long as traders don't make it into a one-way bet, no central bank wants to see the market ganging up on its currency. And the messaging certainly is that they're prepared to step in as and when needed.
Where are Chinese stocks headed when we're seeing the PBOC, of course, in a completely different path when it comes to easing? And at the same time, these geopolitical tensions continue to mount, whether it's with the U.S. or whether it's in the private sector with China telling some of the state-owned firms to phase out using the 4 biggest international accounting firms.
Yeah, it's certainly not helping sentiment, particularly among foreign investors. I mean, the Chinese market is still a huge domestic market. And if the strength of the economy comes through, if the reopening really does gain traction, and if consumer spending stays high within China, and they start to make inroads in the export sector as well, there's enough momentum on the domestic front to still be able to lift Chinese stocks and to do reasonably well. But if they really want to outperform on a global basis, they will need to attract more foreign flows. And it's becoming much more difficult when you do things like make changes to accounting practices. Certainly international investors will not be too happy about that, and they will probably hold back. So you're going to have a bit of a push and pull situation. Chinese stocks can probably still do reasonably well this year based on economics, but for them to really fly, they need to convince the international world that China is really open and willing to see foreign money come in. The yuan is going to be stable, and they can actually see that the fiscal stimulus coming through China is not going to affect monetary policy too much. So there's a lot of things for international people to digest, but don't forget it's still a big domestic economy.
And particularly if you take a look at the valuation gap as well, compared with, say, a lot of these developed markets, Australia, New Zealand, the US, do you think that we're going to see significant repricing after earnings season as the kind of central bank and Fed reality comes home to roost?
I think that the valuation story, it can stay distorted for a long period of time. We've seen it many times in the historical evidence. You just look at Japan, for example. The Japanese market stayed relatively well valued for a very, very long time. It still couldn't attract many foreign investors. There's certainly a risk that China falls into the same category where valuations look good and they stay looking compelling for a very long time before people start to put money back into work. It really needs, people need to be convinced that the authorities in China are pulling in the same direction, that they're doing their best to help private enterprises not get in their way. At the moment, there's quite a few doubts about that. As long as that persists, you could have what seem like attractive valuations lasting for a very long time in China.
Bloomberg's MLive strategist Mark Cranfield there with the latest. You can follow more on this story, all the day's trading, on our Markets Live blog. That's on the Bloomberg at MLive Go. You can get a market rundown in just one click, and there's commentary and analysis from our team of expert editors, so you can find out exactly what's affecting your investments right now. You can also get more of those investment insights in our Bloomberg Intelligence webinar with ARK Investment CEO Kathy Wood. She'll be discussing the outlook for 2023, including ARK's annual research report. Our very own David Inglis will be part of that conversation. That begins at 11 a.m. Hong Kong time. Let's get you here to Sydney now, where Paul Allen has the first word headlines. Paul.
Thanks, Heidi. Reserve Bank of New Zealand Governor Adrian Orr says price pressures are starting to ease, but the impacts of the recent cyclone may require the central bank to extend its monetary tightening. Orr told us he's confident of a return to a low and stable inflation environment. The RBNZ yesterday raised its key interest rate by 0.5 percentage point and maintained expectations for a peak rate of 5.5%.
If inflation expectations continue, if core inflation is more persistent, then tighter for longer is certainly an outcome. We saw early signs of pricing starting to ease, demand coming back, but this additional demand because of the cyclone will continue to challenge the economy.
Bloomberg has learned that Chinese authorities want state-owned enterprises to phase out using the 4 biggest international accounting firms. This signals continued concerns about data security, even after Beijing reached a landmark deal to allow US audit inspections on hundreds of US-listed Chinese companies. No deadline has been set for the changes, which may happen gradually as contracts expire. The Bank for International Settlements says fiat currencies have won the battle against crypto assets. In an exclusive interview with Bloomberg, BIS CEO Augustin Carstens says traditional money still has, in his words, great credibility. The crypto sector is still reeling from a sell-off that wiped out $2 trillion in value. Has been set for the changes, which may happen gradually as contracts expire.
A few years ago, crypto assets and cryptocurrencies were in a way put as an alternative to fiat money. I think that battle has been won. Technology doesn't make for trusted money.
Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Paul Allen. This is Bloomberg.
Right, let's now head back to Bell to see what's moving in the markets. Bell still early in the session. Anything big?
Yeah, that's right, Sherry. We've got the Korean session at 10 minutes into the day's trading here. And at the start of the day, we are seeing basically every single sector in the green in the session. But
I'm Paul Allen. This is Bloomberg.
IT stocks is one that's standing out in particular, given we did have NVIDIA's bullish forecast coming after the bell there. That stock rallying as much as 10% in after hours, and it expects sales to be around $6.5 billion, so slightly higher than forecast for the current quarter. So these are some of the major chip suppliers or stocks in Asia. Of course, NVIDIA is a company that is making a big push into AI chips, and that is really helping to offset that broader slump that we see for PC chips instead.
What's moving potentially not in the right direction here in Australia, Belle?
Yeah, that's right, Heidi. The Australian session is looking a little bit different today. We're really being influenced by those more macro factors, particularly those Fed meeting minutes that underscored that resolve from the Fed to keep up its fight against inflation. But in terms of the session today, also earnings are dominating the mood. We did have Rio Tinto reporting results after the bell yesterday. It's listed in London, so we already had that lead in from the session there, but essentially it reported lower than expected profits, slashed its dividend on weak outlook. This was a reporting period when the lockdown in China was still underway, so we did see weaker demand for those metals. So unsurprisingly, materials, energy stocks are leading the losses on the ASX 200 at the start of the day's trading. But one other stock really standing out to us so far is Qantas, because we did actually see that company really benefiting from that post-pandemic return to travel. Huge demand for aviation. It still, though, is seeing losses of up to 5%, Heidi.
Well, still ahead, we'll be previewing Alibaba earnings, how the company's handled COVID disruptions. Morningstar Investment Management gives us their take a little bit later. But coming up next, we get more from the RBNZ Governor, Adrian Orr, talking to us about the impact of Cyclone Gabrielle on inflation expectations. This is Bloomberg.
Paul Jacobson assured me that when he takes the new Hummer EV on long journeys, it's not just fun to drive, it's equipped to go the distance.
I hear so much about road trip anxiety that I wanted to experience it myself. My family likes to drive a lot, so I brought my daughter home from college in this, and it was great. I mean, the computer system is all intuitive. It tells you how to keep track of the battery. It tells you where the charging stations are. It tells you how much power you'll have when you get to the charging station. So it really puts a lot of your anxiety at ease. But as far as driving it, it's a treat.
So where are you on the charging stations? I know General Motors has made an investment in one company. How are we doing in this country generally in getting charging stations in?
So I think this is an area where obviously we can continue to improve as a country and a society. We're doing our best. We've committed almost $1 billion to EV charging. So we've taken that and looked at home charging solutions, local community solutions, and road trip charging solutions. With my daughter, what we would end up doing is probably stopping, grabbing a bite to eat, plugging it into a charger, usually a high-speed charger, to get as much charge as we can, and being there for 20 to 30 minutes. Get us a lot of range, and by the time we've used that range, we're tired, ready to stop again, etc. So it was a really good experience for me, and it's taught me, number one, what are the concerns of the consumer that are ultimately going to drive our vehicles, and then number two, where do we need to focus on addressing some of those anxious points for people?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Earnings season is here.
Earnings expectations have already reset a lot.
Emerging markets are really set to outperform.
Growth outlook remains fairly stable.
Bloomberg breaks the numbers first.
We're getting the preliminary earnings numbers.
Below what we have historically.
It's a huge drop.
With exclusive expert analysis.
Does it look like this is a Samsung story or an industry story?
There are risks out there.
We're climbing a peak.
We see a substantial upside.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Bank of Korea is expected to hold rates steady the first time in a year. Our global economics and policy editor Kathleen Hayes is here with the latest. Another exciting BOK day.
Exciting pause, but it is kind of exciting because you follow the Bank of Korea very closely too. And they were one of the early rate hikers back in 2021 and 2022 when the Fed was still waiting to taper and not knowing what it could even think about doing next. The Bank of Korea was one of those who got in, started hiking rates, and they've had some success with all of these rate hikes, but they're ready to pause. That's what's expected. You can see the inflation rate, and that tells a lot of the story. It was expected to come in the fourth quarter at 5%, a little bit higher at 5.2%. It's supposed to be down around 2%. That's where they would really like it to see. They've got a long ways to go. So why are they pausing, Kathleen? Well, the reason is that they're getting worried about their economy because they see that exports have slumped. Now, that might start turning around a bit as China continues to reopen, as its economy picks up. Maybe that will help them. You've got weak housing. You got slower spending. The GDP contracted in the fourth quarter on a quarterly basis, not on a year-over-year basis. Year-over-year, it was up 1%. It was only down marginally on the quarterly basis. Nevertheless, it seems like this is a prudent time to pause. That's what we're expecting to hear from the BOK in this hour, except for one thing. In a report to Parliament yesterday, this report said that they're still watching if the possible need for rate hikes. So again, messaging, press conference, big deal for the BOK today.
And Kathleen, the minutes of the FOMC really clearly flagging more rate hikes ahead. What scale are we talking about there?
Well, that's it. I love that. The scale, 25 or 50. And the minutes made it very clear that while all Fed officials agreed that more rate hikes will be needed. Look at this. The restrictive policy stance would have to be maintained until the numbers coming in give us confidence inflation is coming down on its way to 2%. And that's going to take a while. Meanwhile, there were only two of the Fed officials who wanted to go back to 50 basis point rate hikes. Everybody else wanted to stick with a 2% reading. Now, John Williams, president of New York Fed, speaking just in the last couple of hours, saying that it's going to take time. It is their number one commitment. They're going to get there. But just pointing that out, that this is something that doesn't happen overnight. Market's more in step with the Fed now, though. They're looking for 3 25 basis point rate hikes at the next 3 meetings, and that will get them up to about 5.25%, 5.4%. So how do you think the market's more in step with the Fed, even if 2 of the Fed officials are still hoping for 50 and certainly didn't get them to the last meeting? We'll see if anything changes enough to get it with the next.
Kathleen Hayes, our Global Economics and Policy Editor, there with a look ahead to the BOK. You can get more on your Bloomberg. That's commentary and analysis.
The Fed now, though, they're looking for 3 25 basis point rate hikes.
This is from Bloomberg's expert editors as that decision breaks. Well, Reserve Bank of New Zealand Governor Adrian Orr says he's confident inflation will go down and stabilise as he keeps his options open on rates. He told us what policymakers would need to see to revert again to jumbo rate hikes.
It would take a significant upside inflation shock from where we are. So, we are back at 4.75% for our official cash rate. We're still projecting the OCR coming quarters. We're comfortable with that. The economy has been unfolding broadly as expected since our November statement. So we would need a significant surprise.
Well, you've talked about the fact that the cyclone, the impact that you can look through, you have to look through like temporary spikes in prices. But there does seem there's a risk that some of those temporary spikes could become more permanent. At the very least, would that mean that you may have to keep rates higher for longer?
That is correct. As always, there are upside and downside risks in any forecast. And the cyclone, while in the near term we expect output to be disrupted, it definitely will be disrupted, and some price pressures. Over the medium term in our projections, we're looking at about a 1% addition to GDP. So that's over coming years. Now, that is well manageable within the current monetary settings, but if inflation expectations continue, if core inflation is more persistent, then tighter for longer is certainly an outcome. We saw early signs of pricing starting to ease, demand coming back. but this additional demand because of the cyclone will continue to challenge the economy.
When you take a look at the global landscape, with all of the uncertainty, 1 year on, the war continues in Ukraine, China's recovery is on foot and the reopening, there's a lot of question marks over how it plays out. Are you confident that central banks globally will be able to tame inflation? Do you envision returning to a period of subdued price pressures, or do you think the outlook is a lot more volatile?
I don't think the outlook is any more volatile. We always like to, every time we look ahead, we think it's more uncertain than usual. Yes, there are challenges everywhere, but some of the risks you just mentioned are actually downside on inflation pressures. Central banks know their game. We're doing our job. Economies are evolving broadly as anticipated, excluding these ongoing shocks. So, I'm very confident that low and stable inflation will return.
Governor, here in the U.S., we are seeing inflation moderating perhaps a little bit faster than it is in New Zealand. With hindsight, do you feel you should have been more aggressive in the beginning, as the Fed has been? And this time around, if you're telling us that inflation remains elevated, why did you slow the pace of tightening?
So on the first one, no, we've been incredibly aggressive with our tightening. We've started from 0.25, we're at 4.75. We were first in the world by a couple of quarters, and we kept going quickly. So I don't think being any faster would have made much difference to what we're looking at.
That's our conversation with the Reserve Bank of New Zealand Governor Adrian Orr. We have plenty more to come on Daybreak Asia, including the Bank of Korea's rate decision anytime now. This is Bloom.
You know what I think is really interesting about all this is that, thinking about, okay, the last time we had this big bout of inflation, the answer is right, deregulate everything, deregulate trucking, deregulate ports, deregulate airlines, deregulate electricity, and so forth. It's interesting now, obviously we're in this other phase of inflation, and yet no one really talks about that because I think everyone thinks, well, we've already squeezed everything out of the deregulation lemon we're going to get. And now, if anything, our approach is very different and much more sort of, at least the Democrats' approach is much more active involvement in industry, purposeful efforts to expand the supply side.
Well, this is kind of what we were speaking about with Ezra Klein recently, right? The idea that previous supply side measures were all about cutting taxes, deregulating, making it easier for people to produce more that way, whereas this new supply side liberalism is more about actually smoothing the business cycle and how to encourage investment.
What's happening with the business? It's I think the last time, when we were talking about trucking before, is probably when prices were way up, but now they're down, huh?
Yeah, so on the business, on the market side, we are seeing, especially for spot rates, which are more likely to be taken by owner-operators or leased owner-operators, those are going way down. Contract rates, there are signs of that finally softening, and that affects more the larger trucking companies. So we're definitely seeing a softening in the trucking market right now. Diesel is still really an affordability issue especially for smaller companies. Equipment is still hard to come by. There's still all of these major headwinds, and it is definitely a challenging time to be a small trucking company right now.
The head of the Bank for International Settlements says the battle against cryptocurrencies has been won. Agustin Carstens told us exclusively that he expects a strong statement supporting regulation of digital assets at this week's meeting of G20 finance ministers and central bankers.
What we want is to lay the ground, the infrastructure for a modern financial system. Now, the technology is moving very fast. We have a very solid foundation, so the idea is basically to use that solid foundation, incorporate the new technologies, and facilitate the development of a future financial system.
What gaps in particular are you trying to fill?
Well, one, of course, is that financial system, as efficient as it is today, is still full of transaction costs, compliance costs too. So one very important motivation is to reduce those frictions as much as possible. The other thing is to onboard more people more easy. For example, one of the main issues related to lack of sufficient inclusion is that precisely transaction costs are very, very high. Therefore, to manage small payments or to give access to small firms, so small, medium-sized enterprises, or services to people in remote areas is still a major problem.
One of the priorities for the BIS in 2023 is to focus on stable coins, on CBDCs as well. I'm just wondering, in terms of regulation, what additional regulation do you foresee that's needed?
Well, in terms of, yes, cryptocurrencies need to be regulated. It is obvious now that it is necessary. Certainly aspects of consumer investment protection is very important. And well, of course, also focusing on the exchanges. The exchanges are key. How some of these activities interact with the traditional financial system. Some should be valid, some should be tolerated, and those are the ones we should regulate.
What do you think is impacting the views of central bankers the most right now when it comes to the crypto ecosystem? I mean, how much of it has to do with the FTX incident, for instance?
Well, you know, a few years ago, crypto assets and cryptocurrencies were in a way put as an alternative to fiat money. I think that battle has been won. Technology doesn't make for trusted money. The most important aspect is for these activities not to have a systemic impact. I mean, at the end of the day, if this grows dramatically and we have events like FTX, that at some point could have a systemic impact. And that's something that we want certainly to prevent.
India, which is hosting the G20, is pushing for greater regulation on cryptocurrencies. What conversations are you expecting at the G20, and where are they in those conversations?
I would say the most important body of the G20 that has to do with financial activities is the Financial Stability Board. The Financial Stability Board, where ministers of finance, regulators, central banks get together and they decide, I would say, the main rules of the game, I would say, for the international financial system. I anticipate a strong statement in favor of regulation. It will be up to each country to decide which particular approach they will follow in terms of the alternatives that there are out there.
Augustine Carstens there of the Bank for International Settlement speaking to our very own Linda Amin. Well, coming up next, a Bloomberg scoop why China is urging state-owned enterprises to back away from using the world's big four accounting firms. This is Bloomberg.
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
BSO Now. Your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Daybreak Asia. I'm Annabelle Drawlers, and we are certainly on the countdown now to the Bank of Korea decision that could come within the end of this hour. Now, the expectation from the vast majority of economists here is for officials in Korea to keep that key rate on hold at 3.5%. That would be the first unchanged decision in a year. Now, looking at how Korean assets are likely to react, if you see the Korean won today, it is just slightly stronger against the US dollar. But when you take a look at how it's been performing over a 5-day basis, you can see it is most certainly the biggest laggard here in Asia, down around 1.5% against the greenback. What's been happening, of course, is that traders have been anticipating this hold from the Bank of Korea, and that really does stand in stark contrast to what's come through from the Fed, because those latest meeting minutes really indicating that it does have that resolve to fight inflation, and they are prepared to hike more. Traders as well expecting perhaps another 75 basis points in order further hikes to come. If you change on now how that is playing out in the session today, well, we're very much focused on those Fed meeting minutes. That is just generally dragging down the MXCAPJ index. Japan, of course, shut today for a public holiday, now holding steady. The big losses coming through in the materials sector, that one off around 1% at the start of day's trading, down to what we're hearing in terms of earnings. Rio Tinto, for instance, sliding today. Sherry, that's really more of a question of the demand outlook from China. Are we really going to see that rebound come through on a steady footing? Metals demand has been weak, and this company as well feeling the impact of those more macro forces at play.
All right, but let's actually stay with China, because Bloomberg has learned that Chinese authorities are urging state-owned enterprises to phase out using the 4 biggest international accounting firms, signaling continued concerns about data security. Let's bring in our Greater China finance reporter, Kyuyan Wong. Kyuyan, so we know that this is coming amid heightened tensions between the U.S. and China. What exactly is Beijing telling its state-owned enterprises?
So from what we understand, that China has been asking the state-owned firms to gradually replace the Big Four with local Chinese or Hong Kong auditors. So the cut ties need not to be immediate, but to be gradual and let it phase out.
So they just reached that landmark audit deal last year after decades of disagreement on this, and it, saved hundreds potentially of Chinese firms from being kicked off American exchanges. So why this latest development, and does that have an implication for those companies?
Well, for one thing, the PCAOB inspection was successful, but then Beijing was still worried about the data security with the financials being handled by Western auditors. On the other hand, Beijing also wants to groom its own professionals locally. So it's kind of like adding another layer of tension between the US and China for sure.
What are the implications for Chinese companies potentially being delisted from New York then?
Well, it depends, because using Big Four is not a must to stay listed in the US, but rather the auditors and the companies must comply with the PCAOB inspection in order to stay listed in New York. So as long as they can comply, then they should be safe.
What about PetroChina, China Life? Some of these companies are already applying to voluntarily delist.
Well, even they have left the US market, it doesn't mean that they are free from PCAOB inspection, because the agency could do it retrospect inspection to make sure that they were compliant during the listing year.
Okay, so what does it mean then for international investors looking into China? I mean, we have heard the valuations are at distress levels. There's great opportunity in China, but at the same time, these concerns continue.
Well, it would be certainly be even more difficult for the state-owned companies to tap international capital if they do switch to smaller firms instead of sticking with the Big Four. Well, but then, I mean, the impact is still very early, and we have to wait and see for that.
Bloomberg's Kyuyan Wong there with that story. Well, sticking with China, investors will be watching Alibaba's results due out later for a barometer of post-pandemic online consumer demand. Joining us now is, with a preview I should say, is Chelsea Tam, who's a senior equity analyst at Morningstar Investment Management. So we're watching in particular for how Alibaba managed to weather the COVID disruptions, as well as, I guess, the strength of demand as we get those first couple of months after the reopening.
Yeah, so I think in terms of delivery capacity, it has normalized. So now I think what we are really looking forward to the earnings announcement and management guidance is whether they will start to give guidance again for full year revenue and their mentions of how the recovery of consumption has been. We are sure that as delivery has normalized, cancellation should have decreased. So that should help the take rate for Alibaba. Another thing that I think we need to watch is obviously we see that JD is now rolling out a daily based 10 billion subsidy program. So potentially that will drag Alibaba and PDD into more subsidies as well.
What is really the renewed worries when it comes to Alibaba and broader tech in China? Because for a while there, it felt like there was, things were improving, right? The regulatory crackdown seemed mostly over.
Yeah, so in the e-commerce space, I think it's the renewed worries of some kind of price war, which will reduce the margin of these companies. Obviously, I think they will see some increase in the top line because basically you're subsidizing customers to buy more of your products, but then it will be at the expense of the margin. Recall that in the last few quarters, we see really good cost-cutting measures across the tech companies and the e-commerce companies. But I think there's a concern that now we're going backwards to the to like a lower than expected margin.
Where are the bright spots then?
Well, I think the bright spot is management's sort of really like sorting out for investors, like how the strategy is going to be. Is it possible that the subsidy is actually not as large as they expect? And also, I think the strength in consumption recovery is very important. So or if governments, like for example, local governments, are willing to roll out more support in consumption, I think that will also be helpful. So I think we're looking forward to the large government meeting in March to see if there will be more specific government supportive measures.
Who's doing it well so far in positioning for the next year of higher consumption and also potentially more government support?
Well, I think that when it comes to government support, and let's say if the economy accelerate faster, and let's say employment sort of revert back to the normal level faster, and people have a sort of feel good wealth effect, then discretionary goods should see more demand, and that should benefit Alibaba quite a lot because they actually have a big focus on apparel and like some of the discretionary items like beauty products, for example, and also. Like if there's a consumption upgrade story, then it will also benefit Alibaba. On the other hand, it's interesting that so far we're still seeing PDD, Pinduoduo, doing really well with this value for money strategy. It doesn't mean that it is like only selling cheap goods. It just means that, for example, for the same high quality brands, you can buy a cheaper price at PDD compared to maybe some of the other platform or perhaps offline. And this is at least partly due to subsidy. So I think these two companies are doing quite well. Even if the economy is improving, it actually still makes sense for value for money platform like PDD to continue to do well because you always want to buy at the cheapest price for the product that you like.
And you want to buy also the cheapest stocks when you can. I think you have a buy target price for Alibaba at 171. What are you seeing in terms of valuations in the tech sector in China?
Yeah, I think the valuation, I mean, now with the news of renewed subsidies, I think there would be some pressure on the stock ahead of earnings. We're waiting for sort of the management to give more guidance on how they are going, like whether, for example, Alibaba will follow the subsidies and things like that. So I think there would be some concern that would weigh on multiples. I think for multiples to expand and for share price to further increase, I think we need a more positive sort of guidance from the management, especially on cancellation rate or
Chelsea Tam there, Asia Senior Equity Analyst at Morningstar Investment Management. We seem to have lost Chelsea for a little bit at the end, but of course previewing Alibaba and really talking through this new risk when it comes to the tech giants in the form of potentially this price war, Sherry.
And of course, Heidi, we'll have more analysis on China tech. Blue Lotus Capital Advisors joins us later for a closer look at Alibaba and Baidu's earnings as well, Heidi.
Let's get to Paul Allen, who's here in Sydney with the First Word headlines. Paul.
Thanks, Heidi. Federal Reserve officials anticipate more rate hikes to curb inflation, though most support slowing down the pace. Minutes from the Fed's meeting 3 weeks ago say almost all officials agreed to an increase of 25 basis points. Only a few were said to have supported a 50-point hike. A number of officials said an insufficiently restrictive policy stance could stall progress on moderating inflation. Russian President Vladimir Putin says he's waiting for his Chinese counterpart to visit Moscow. Xi Jinping is reportedly preparing for a trip in April or May to push for multi-party peace talks. China's top diplomat Wang Yi met with Putin in Moscow, the Russian leader hailing deepening ties with Beijing and Wang calling their relationship solid as a mountain. G20 host India is said to be resisting using the word war in any joint statement when referring to Russia's invasion of Ukraine. That would diverge from a consensus reached by leaders in Bali last November. A source says Indian officials would prefer calling it a crisis. We're told the hosts are also concerned that plans for additional sanctions on Russia will draw attention away from other G20 priorities. A vast winter storm is pummeling the central US, dumping record levels of snow, closing highways and knocking out power in California. More than 1,500 flights were reportedly cancelled and thousands more delayed. Blizzard warnings are in place in Minnesota and the Dakotas. At the same time, some mid-Atlantic and southeastern regions are feeling record heat for this time of year. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Paul Allen. This is Bloomberg.
Well, coming up next, we'll be dissecting Qantas earnings as the Aussie airline rebounds to a record profit with demand outpacing capacity. That stock has been falling in the day session, though. This is Bloomberg.
McDonald's is more than 60 years old now.
Yep.
What is it that made McDonald's by far the biggest of the fast food companies?
I think it starts with the brand. I mean, we have a brand that is one of the most valuable brands in the world. It started with, I think Ray Kroc recognized the importance of ubiquity. And so that was part of the genius or genesis of doing a franchise model, because with a franchise model, he could get capital deployed, get restaurants built more quickly than he could if he was trying to do this all on his own.
There's been a greater interest in the United States and maybe around the world in healthier eating.
Yeah.
Have you tried to reflect that in your menu?
I'd say, what we try to do on our menu is to have choice. So we have a variety of things on our menu, from more indulgent items to, healthier items. And, it gets back to, again, what sells gets on the menu and stays on the menu. What we have seen consistently is, as we've tried to broaden more of what people might say are better for you items, there's just not as strong a demand for them as there are for some of our iconic classics. And so, we're not in the business of telling people what they should or shouldn't eat. Our view is our obligation is to provide them with total transparency on nutritional information to make sure that we afford them choice, but ultimately what the consumer buys is up to them.
Here's a quick check of the latest business pandemic-related losses, and we'll consider resuming dividends. It sees a full-year pre-tax profit of up to $329 million, reflecting sustained domestic and international demand. The airline CEO says the recovery is well underway, with operating performance steadily improving. Australian casino operator Star Entertainment has raised $545 million in fresh equity. The windfall may offer breathing room amid tighter regulation and potentially higher taxes. Star's market value tumbled after it was found unfit to hold gaming licenses last October due to poor anti-money laundering controls. Baidu's U.S.-listed shares reversed early gains after it reported better-than-expected revenue and a $5 billion share buyback. The Beijing-based company is leading a race to create China's answer to ChatGPT. It plans to embed its Ernie AI tool in its flagship search services in March. JP Morgan has curbed its staff's use of the ChatGPT chatbot. A source says the artificial intelligence software is currently restricted. The move impacts employees across the firm. We're told it was not triggered by any specific incident, but reflects normal controls around third-party software.
Take a look at Qantas shares down by just about 5.8%, falling, in fact, by the most in about 8 months. The airline announcing a record first half profit. We also had, of course, just the general narrative of travel demand coming roaring back after the pandemic. We are getting some more now. Paul Allen joins us now in Sydney. So we expected strong numbers. Investors are not liking that. A lot of this concern about capex potentially being higher than expected.
Yeah, Qantas has ordered some new planes. It's maxing out its order, really. We've got 9 new planes on order. Qantas exercising its right to take those. The firm orders now for 29 new planes, which will arrive full fiscal year 26-27. So yeah, costs rising. We're dealing with fuel costs in the short term as well. That bill expected to be $4.8 billion for the year. The wages bill also rising. That's expected to be $4 billion for the year. But the overall result, very strong. And as you say, we were expecting that. 1.43 billion Aussie dollars, about 950 million US for the half. Very narrow miss. Net debt is declining. That's down to 2.4 billion. No interim dividend, but really we weren't expecting one. But another share buyback to the tune of about $500 million on top of the buyback that was announced back in August. So overall, a good set of numbers, and domestic capacity coming back too. That'll be higher than pre-pandemic levels by the end of the year. International capacity taking a bit longer to come back. That's seen at 81% in the second half. Qantas, like a lot of airlines, really struggling to get parts, staff, pretty much everything you need to get back in the air.
Paul Allen there with the latest on Qantas as we continue to see that huge fall in its stock price. Plenty more to come on Daybreak Asia, including, of course, the Bank of Korea's rate decision to come anytime now.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Right, we're awaiting the Bank of Korea's rate decision. The anticipation right now is that it will pause at 3.5%. This would, of course, be the first unchanged decision in a year, Heidi. So really exciting times. Ooh, it's come out. Bank of Korea leaving its key rate unchanged at 3.5%. 17 of 18 economists surveyed forecast that the BOK will hold rate at 3.5%, and it's come through. And this, of course, coming at a time when we are expecting the Bank of Korea also to come out with their growth forecast. The expectation was that they would actually lower the forecast, given, of course, the export slump, the pressure on consumption. Our global economics and policy editor, Kathleen Hayes, is here with me to break all of this down. Exciting, BOK unchanged, 3.5%. And I guess it's more exciting because it's the first major central bank to actually hold rates steady.
Well, I agree. And I think what's interesting too, Sherry, is that as you said, we have the RBNZ yesterday. They raised their rate, but they downshifted. That's the story for the Fed. Downshifted 50 to 25. BOK is not messing around with any downshifting. Well, actually, they have downshifted because they didn't keep doing 50 basis points over and over. But they have made this is an important move. They did see, as Sherry was just mentioning, GDP growth 2.4 versus 2.3, so they actually raised it a little bit. The CPI forecast, though, looks at 2.6 versus 2.5 in November. One of the things that's interesting, you guys, is I think that the central banks are having a little bit of trouble keeping their forecasts in line with reality, right? They get ready for something to come down, to look better, and it doesn't improve quite as much as it should. And in fact, right now, Korea's inflation rate's at 5.2% year over year. They need to get it down around 2%. But as you point out, they are concerned about the economy with good reason. And after having done several rate hikes in a row, looks like, Heidi, that they figure they can pause. And again, the press conference in the next hour and a half or so is going to be crucial to having us understand what kind of pause is this, right? Is this a pause and we think maybe we're about there? I don't see how they could say, or they're about done if they got the inflation up to 5%. Or maybe they figure that they've done enough to sit back and watch for the lags of monetary policy to work and gradually bring that down. Those are the kinds of questions that Lee Chang-yong is going to be asked.
Yeah, we are seeing just some more lines coming through when it comes to that 2024 GDP growth seen at 2.4% versus a 2.3% in November, revising that CPI forecast for 2024 to 2.6% against 2.5%. So a little bit of a tick high when it comes to the inflation and growth outlooks there. What are some of the other concerns? Because when we talk about Korea, it's usually household debt, right? But we've actually seen loans to households falling. I mean, this is a good thing, but it also ties in with what we're seeing when it comes to the housing market as well.
Well, that's it. We've seen how housing markets cool off across the region, right? In Korea, in Australia, in New Zealand. It's happening all those places. I was at that meeting in November with Lee Chang-yong, and one of the things I did ask him about was, what are you going to stop hiking rates and then start cutting them? He said, oh, no, we're going to keep them high for a long time. And I think that's another thing people are going to be asking. He says, it's one thing to stop hiking rates, but the next question is, and markets are always thinking, well, gee, if they've stopped hiking and if they think they've moved enough or they're moving in the right direction, will they pause? Will they start signaling the move lower? And 3 months ago, he was adamant that no, the rates would go high and they'd have to stay high for a long time. We heard Governor Orr from the RBNZ today telling us the same kind of thing, and we heard John Williams from the New York Fed saying the same kind of thing. That's the message. Unfortunately, or fortunately for markets, because it'll be good to get inflation down, but I think most investors want to see the move getting away from the tightening, get away from the lack of liquidity, and start putting some back, because that's what powered all those wonderful stock market rallies during and coming out of the pandemic. But for now, I think that's going to be another very important issue to raise.
It's really interesting that Heidi mentioned household debt, because this is something we talked about with Bank of America earlier today, that household debt is no longer a problem. Well, it's no longer such a big problem. It's more about corporate debt, because they become too leveraged. So unless corporate debt actually starts falling, that the BOK won't be able to move. So they were expecting a hawkish hold. And I wonder if this upgrade of 2024 growth forecast, the upgrade for CPI forecast for 2024, is that hawkishness.
Exactly. It's saying that inflation is going to come down, but we're not going to be close enough to our target. So again, we will not be quick to cut rates. And I think that's the important part of it, Sherry.
Our global economics and policy editor, Kathleen Hayes there. You can turn to Bloomberg for much more that live reaction to the BOK decision to hold. Go to TLIV Go to get commentary and analysis from Bloomberg's expert editors as we continue to watch for more signs of guidance, in particular from the Bank of Korea in that revised outlook when it comes to both growth and CPI. Still to come, BlackRock tells us why they're cautiously optimistic, I should say, when it comes to the Asian credit market. They believe investors should pause and wait for better entry points. CICC research shows why they believe the offshore China market has lost steam. Plus, Blue Lotus Capital Advisors joins us for a look at Baidu results and also ahead of those Baba earnings as well. That is it for Daybreak Asia. Our markets coverage is next before the start of trading in Hong Kong, Shanghai and
You're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel. And I think fashion is fascinating for the mood changing, the confidence boosting aspects, and the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring, I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
and good morning. It's 9 a.m. here in Hong Kong, up in Beijing, and also in Shanghai. Welcome to Bloomberg Markets China Open. I'm David Ingles with Yvonne Mann.
Our top stories this morning: risk assets face headwinds. Traders pricing in 3 more Fed hikes after minutes signal ongoing inflation worries. The Bank of Korea hitting the pause button after a year of rate rises. Baidu announces a $5 billion share buyback after revenue beat expectations thanks to strength in its cloud computing service. And a Bloomberg scoop: Beijing urges state-owned enterprises to cease dealing with the big 4 global accounting firms.
Yep, we'll get into that story a bit later on. That will certainly have a lot of implications on things like the veracity of the data and whether or not, of course, it will bring a lot more uncertainty as far as really what we're looking at as financials are concerned. Speaking of the big 4, here's the big 4 assets we're looking at today. Japan is shut, so we're looking at MSCI ex-Japan. US futures, as you can see, a third of 1% to the upside. So we're pulling back a little bit on the dollar strength we've seen of late. We're looking at still 104.50 though on the dollar index. Have a look at the China here, the China board at least, in the approach to the open. So a couple of things, right? A big earnings day. You had Baidu yesterday, you had Alibaba today, plus a lot of the big property developers. Inflation's coming out of Hong Kong. That's another one to watch. This tech rot that we are continuing to see within this space. JD.com notwithstanding here. Earnings, speaking of, UOB's out with earnings today, 1.5%. Singapore's coming online. A rate decision, which we'll get to in just a moment. It looks like the Bank of Korea looks like they're done for now. And of course, in commodities, this big route, this extended route we're seeing in the energy space. The Chinese contract is coming online, down about 2%. And as you can see, we're now almost in the looking at a 7 handle here as far as Brent is concerned, down about 3%, give or take, on both big contracts yesterday. Copper, as you can see, is doing that, up about $4 as we speak. Yvonne.
Yep, certainly a big week for oil as well. I think it's the longest losing streak for WTI this year already. Just take a look at when it comes to the BOK, though. That is our top story here this morning. Amid sort of this whole Fed repricing, the Fed minutes here, you have now a central bank in Korea that's signaling, at least hitting the pause button for now, also downgrading their inflation and growth forecast for the year. Let's bring our Kathleen Hayes, Global Economics and Policy Editor, with more analysis. And Kathleen, is the BOK done?
Well, are they done is a very interesting question. Are they done hiking rates? They may very well be, but let me tell you this. In November, I was at I did an interview. Governor Yi joined us at the Bloomberg Bureau in Seoul, and he made it very clear that once they stop hiking rates, don't expect them to start cutting them. They are going to have to keep rates high for some time. And I think that's going to be a tricky question with all of these central banks and with investors and with consumers, and businesses. Is it okay just to keep those rates higher? Would you like to see them come down? Now, as for their forecast, they just ever so slightly lower the GDP forecast, 1.7. That's what they saw in November, to 1.6 for the year. CPI 3.5 versus 3.6. So it still doesn't get to target. Target is just around 2%. And on the GDP, they raised it a little bit for next year, 2.4 from 2.3, CPI 2.6 from 2.5. So with the CPI numbers, it seems like they'll be within sort of a 1 to 3% band, but not near 2%. And we'll find out what they say next. In the press conference, I think he will be asked that question again. Are you going to start cutting rates? I think the governor will also be asked about inflation. If it's at 5.2% now, why are you so sure it is going to come down enough for you to stop hiking rates more? We understand that you're worried about the economy, about weaker consumption, about weaker exports, about a housing construction industry that has slowed down, about that little marginal drop you had in GDP in the fourth quarter. Year over year, GDP rose 1.4% in the fourth quarter. There's all kinds of these small red flags, not big ones, that are waving. Find a pause. I think the question is, does pause mean stop, or does pause mean we're pausing now to see if we have to do more?
Yeah, well, speaking of doing more, Kathleen, you had a conversation with the RBNZ governor a couple of hours back, and I think the way he phrased it was it would take a significant price shock for them to return to bigger rate hikes. I mean, that takes us into Fed minutes. If you could just wrap that all together for us. Inflation is still here, is the point. We might not get the bigger rate hikes, but these hikes are still coming, aren't they?
Absolutely. It's so important to underscore that because, look, if you go from 75 to 50 which is what the RBNZ did. Those are still big hikes, right? Much more than 25. And the Federal Reserve went from 50 to 25. Not quite as big, but they're still, the Fed is still signaling more rate hikes. And in fact, Adrian Orr, RBNZ, is still signaling about 3 more hikes. That's what's expected from the Federal Reserve as well. I'm trying to think of what the difference would be here. I think that the Fed is perhaps a little more uncertain about how much they're going to have to do because inflation has come down, but it's kind of paused in the speed with which it's coming down. I think with the RBNZ, Adrian Orr seems to have a little more conviction that they've done enough. When they get their official cash rate to 5.5%, they're more certain that they're going to see more early signs of the demand weakening more and that kind of thing. But he is watching inflation expectations very closely. I do think they realize that their wages are still rising. They've got contractionary policy, he says now. I think they're hoping they've done enough, but realizing they may have to do more. And I guess in that way, maybe the Fed and the RBNZ are a little more similar than they are with the BOK. However, when we hear the governor of the Bank of Korea talking in just an hour or so, I think we'll get a much better idea of where he exactly is standing on these more nuanced but important questions.
Kathleen, thank you. Kathleen Hayes there. Breaking down the BOK for us out of New York. You also turn to your Bloomberg for more. We have plenty of analysis and commentary from our expert editors on the BOK as we count down, of course, to that press briefing at the next hour, top of the hour there. And of course, we're going to be speaking to the man himself, the BOK governor, Lee Jong-yong, on Friday to go over today's decision and discuss what comes next.
Yep. Is he going to give us an indication of whether or not they are, in fact, done? Full stop. Okay, let's bring on our next guest who says that he remains cautiously optimistic on the Asian credit market. Let's bring in Neeraj Seth, BlackRock's CIO, of course, and head of Asian credit, joining us out of Singapore. Good morning, sir, and very nice to see you. Hopefully next time under better circumstances. His bond route, of course, is what I'm alluding to here. Let's start with you as rates. Your expectations for Treasury yields will be what at this point, though?
So I still think the base case scenario, you see the yields drifting higher from here. And as the markets obviously reprice 2 things. One is obviously the terminal Fed fund rate with potentially 3 more hikes. And then the rate cut expectations, which are getting priced out. So on the margin, I think we are 80% of the way there, if not 100. So I do think maybe a bit more of the backup in the yields, and you are at fair value from a Treasury standpoint. Now, there will still be data dependency as we look forward from a Fed decisions perspective. So you can't obviously take a firm view of exactly where you stop. But the current base case is you get 3 more hikes and then potentially a pause.
So, given what we saw in January, this rally of almost everything, you're starting to see at least credit spreads widen again. Is that an opportunity for you to put money to work?
I think we're getting there. Even I think you have to be patient in these markets. These markets are more like 2 steps forward and maybe 1.5 step back. So we're still obviously positive for the year, but we have given back almost 60% of the gains in the Asian credit markets from the Feb peak. So I think we are seeing some backup in terms of the rates as well as the credit spreads. I think we're getting close to, again, points where you will see interesting entry opportunity. And that keeps me cautiously optimistic on the markets, but with certainly a level of patience that you would need to have.
Neeraj, if you could give that to us maybe in the form of generally how much more do you think spreads are going to widen then?
So first of all, if I take a longer term view, a 12-month view between now and end of the year, I do expect the spreads to be somewhat more sideways. I'm not expecting a huge amount of spread compression. But going back to the point around the market expectations of the Fed as well as the risk pricing, I think you will get some back and forth, which gives you a carry plus some potential upside opportunity by just being a bit more nimble in the market. So I'm not sure if you see a huge amount of spread widening, maybe on the margin a little bit, but the entry points in terms of all-in yields is becoming quite interesting.
So the volatility that we saw last year, Neeraj, I'm wondering, is there a chance that that could repeat this year? Do you think that, we've seen enough, at least in terms of the clarity, to maybe that, volatility can come down when it comes to FX and local bond markets in this region?
Absolutely. I do not expect a repeat of 2022 in a base case scenario, and specifically given obviously the level of hikes we had in 2022 in the end were 4x of what market was expecting coming into the year. I don't think that repeats in 2023. On the margin, once we get closer to the May and June FOMC, the rates fall in the US should start to come down. And that also provides a better backdrop in terms of the dollar Asia, dollar volatility, and the rates fall, which is a better backdrop for Asia. So I don't think we are in the same scenario as the 2022 from a local markets perspective.
Neeraj, India, China, Indonesia, and the Middle East are the four markets you basically see as attractive in investment grade, to be more specific. Is there anything consistent between those four, or why do you single out the four?
So the key here is looking at where the spreads and all-in yields are specifically in the front end of the curve, and having a combination of the fundamentals, the valuations, and the technical backdrop that's in favor. The issuance in most of these markets is actually quite low at this point when we look at specifically China and India. And on the other hand, Korea and Middle East, where we expect issuance, the valuations are attractive. So that balance of the fundamental valuations and the technicals actually provide you the backdrop to be positive on these markets, specifically for locking in yields in the front end of the curve and all of these in investment grade, where you have a lower risk of default or downgrade scenarios here.
Got to ask you about India, because that's something that you're watching out for here. Just given the whole Adani crisis, I don't think really got you on, Raj, to really comment on this. We've seen sort of them talk about their cash levels. It seems like they're able to repay back some debt as well. Do you think we've reached a floor when it comes to, India credit and as well as what we're seeing at Adani?
So first of all, I cannot comment on single names, unfortunately, Yvonne, so I'll leave that comment out. But broadly, from the perspective of the fundamentals of the investment grade credit in India, I'm reasonably comfortable with that. So it's more around when we see the valuations becoming attractive, we do want to add that in the portfolios. And some of these recent set of events, what it reminds us is it brings us back to the fundamentals of credit, including leverage, liquidity, cash flows, and corporate governance as critical. So I don't think that ever goes away, and I don't think this is a systemic risk for the Indian market here.
Neeraj, final question. We're in the thick of earnings season. In China, particularly, we had Baidu yesterday, I think. We had news on JD.com earlier this week. I think Alibaba's coming out today. The reason I bring that up, when you look at these, the yields on offer there, I think 4 to 6%, give or take there. Is that good value for you, or do you think that we could see that those spreads widen a little bit further? Because these companies are coming out with not so positive news.
So I think, first of all, from a credit standpoint, you're looking less at the growth and earnings from an earning growth perspective. You're looking at more the predictability and the stability of earnings and the stability of cash flows. There's a slight difference here. So when you think about the fundamentals of credit and you have a trajectory which looks stable and the valuations are attractive, you would actually be on the positive side, which might not be exactly the same view when you take the equity market perspective.
Neeraj, I'll leave it there, but thank you so much, Neeraj Seth, BlackRock CIO and head of Asian credit, joining us from Singapore. Here's your first word news now. Reserve Bank of New Zealand Governor Adrian Orr says price pressures are starting to ease, but the impact of the recent cyclone may require the central bank to extend its monetary tightening. Orr told us he's confident of a return to a low and stable inflation environment. The RBNZ yesterday raised its key interest rate by a 0.5 percentage point and maintained expectations for a peak rate of 5.5%.
If inflation expectations continue, if core inflation is more persistent, then tighter for longer is certainly an outcome. We saw early signs of pricing starting to ease, demand coming back, but this additional demand because of the cyclone will continue to challenge the economy.
G20 host India is said to be resisting using the word war in any joint statement when referring to Russia's invasion of Ukraine. That word diverged from a consensus reached by leaders in Bali last November. A source says Indian officials would prefer calling it a crisis. We're told the hosts are also concerned that plans for additional sanctions on Russia will draw attention away from other G20 priorities. A vast winter storm is pummeling the central U.S., dumping record levels of snow, closing highways, and knocking out power in California. More than 1,500 flights were reportedly canceled and thousands more delayed. Blizzard warnings are in place in Minnesota and the Dakotas. At the same time, some mid-Atlantic and southeastern regions are feeling record heat for this time of year. And those are the first word headlines.
Yep. In fact, feeling the heat are these markets here in Hong Kong. We are flirting yet again. We've been on correction watch really these last few days or so. In fact, just ahead here, we'll be speaking with a strategist who believes the rally is actually not over when it comes to the offshore equity market here, and that there is still a window to invest. We'll ask him where specifically when he comes on at 9:30. There we go. Also coming up, China telling its state-owned firms to start disengaging, backing away from using the world's 4 biggest accounting firms. More on this Bloomberg Scoop coming up just ahead. And just counting down to the open of trade, the reference rate for today is out 690.28 against the US dollar. The opening bell 14 minutes away, Shanghai, Shenzhen, and here in Hong Kong. This is Bloomberg Markets China Open. Good morning.
Why does everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The moment news breaks, no one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority. Season is here.
Earnings expectations have already reset a lot.
Emerging markets are really set to outperform.
Growth outlook remains fairly stable.
Bloomberg breaks the numbers first.
We're getting the preliminary earnings numbers
below what we have historically.
It's a huge drop.
With exclusive expert analysis.
Does it look like this is a Samsung story or an industry story?
There are risks out there.
Declining a peak. We see a substantial upside.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Order partially filled.
Well, President Vladimir Putin says he is
Order
waiting
filled.
for his Chinese counterpart Xi Jinping to visit Russia. Meanwhile, the geopolitics certainly is impacting a lot of business and deals alike here. And what we've heard so far, Bloomberg Scoop, China's authorities have urged state-owned firms to phase out using the four biggest international accounting firms, signaling Beijing's continued concerns about data security.
Yep, let's put all these strands together for you. Joining us here on set, Rebecca Chung-Wilkins, our Asia government politics correspondent, and also our Greater China finance reporter, Qian Wang. Let's start with you, Rebecca, because this is really the backdrop of the conversations we're having with the big four accounting firms. You start us off. What do we need to know at this point?
Well, there's sort of two big things going on. One, this is big geopolitical story. Wang Yi, of course, in Moscow with Putin, emphasizing the strength of China-Russia relations, solid as a mountain, as he put it. And of course, this sort of reshaping of the narrative by China, putting a little bit of distance with Russia at the same time, insisting it's not an ally, and reassuring China's role as a sort of neutral mediator. We have, again, more details that Xi himself maybe putting forward this peace plan potentially to end conflict in Ukraine. The US, meanwhile, still very concerned, emphasizing these fears from the State Department, again coming overnight, that China may be considering, has not yet ruled out providing lethal aid to Ukraine, and the US making it very, very clear that that's going to be a big red line for them.
So China then, this trip's still not confirmed, right? Xi heading to Russia. I'm just wondering, are they going to have the influence to really strike some sort of deal that maybe Russia can come out of this with a little bit of saving face and kind of takes away this whole Ukraine issue when it comes to Sino-Western relations too?
I think that's certainly going to be the big question here, as you say, this credibility issue. Can China actually maneuver its way out? I mean, we have learned that that it's going to involve a ceasefire, a potential ceasefire. It's going to sort of be a halting of the violence. But, as many European capitals have made clear, unless any proposal includes the removal of Russian troops from Ukraine, it is not going to be palatable for Ukraine itself and for many Europeans. And so there is this sense that both Ukraine and Russia right now really unwilling to make concessions. That makes China's job very, very difficult. One issue where we could see progress is if potentially China either privately or publicly emphasizes that there's a red line around nuclear use by Russia.
Yeah, maybe even more publicly if they do come out with that a little bit more. Qian, let me bring you in. The other big story here is China, and this is our scoop, asking its state-owned enterprises to start disengaging from the big four. What do we know? And might that actually also lead to delistings in New York?
From what we heard is that the Chinese authority has been asking its biggest state-owned firms to gradually offload Big Four as when the contract expires, then they will naturally let it expire and let them go. Okay. And instead they would engage local Chinese or Hong Kong auditors. But then there is no hard deadline as far as we can hear for now. But then would it naturally lead to another set of this listing from New York immediately? It depends, because using Big Four as audit firms is not a must to stay listed in New York. But as long as the companies and their auditors remain compliant with the PCAOB's regulations, then they should be safe.
We saw certainly a lot of it last year, right? These developers are basically just saying, oh, we're not working with so-and-so anymore. But we were just coming off on this whole audit deal, right, between China and the US, and people thought things were going to be better, and it takes out the whole delisting risk as well. Why the need to cut from the Big Four?
Well, for one thing, the PCAOB inspection was successful in any way you can possibly imagine. But then Beijing also needs the data security very close to heart, right? And also it is trying to grow its own local professionals, give them more experience to deal with bigger companies, and hence we are hearing this kind of directive.
All right, Rebecca Chung-Wilkins, Qian Wang there joining us with the latest on all things politics and how that's impacting now even the Big Four. A great reporting there. Thank you so much. Taking a look at some stocks to watch. We're watching very much the tech space. A lot of earnings to digest. Baidu, the like here. So they announced this buyback program. Did beat the street here when it comes to expectations and what the results came out. 3% lower for Baidu. We got Alibaba coming up next. That's marginally lower, but you're still seeing this route continuing for another day. Tencent as well as JD. company, both falling quite a bit here in terms of earnings. It's not just Baidu, we're talking about and Alibaba. You have the developers in Hong Kong, so Sun Hung Kai. You have New World, you have Galaxy, so some more take on the Macau casinos and how things are doing on the back of this reopening story, too.
Yeah, it looks like we will be entering that correction we've been waiting for these last few days. We're
So
down
close.
0.4%. Lots more coming up. This is Bloomberg.
The idea that you're going to have a short and shallow recession, plain vanilla, garden variety, is totally delusional. I mean, it's totally delusional. We have amounts of debts like we've never seen before. In previous recession, like COVID, GFC, we could do monetary and fiscal easing because you had deflation. Now we have to tighten monetary and fiscal policy into a recession. Inflation is global and everybody's tightening. And therefore, as I pointed out, we get the worst of the 70s and the worst of the GFC. It's going to be long, ugly, protracted with financial stresses, financial instability, and debt crisis. That's what's going to
Muriel,
happen.
I got to say, you're not helping with my anxiety levels right now.
I'm going to go. I'm moving my portfolio to cash. 1 second. I got to pause the
Well,
podcast.
cash is not enough because it's wiped out by inflation. You have to go to assets, and I can discuss, they can hedge you against inflation. The 70s, both equities and real estate did poorly, but equity did much worse than real estate. The P ratio for S&P was down to 8 in 1982. Because real estate is in fixed supply, you can often reprice the rents, and it's a good hedge against inflation as long as monetary policy is not very tight. Of course, the REITs this year have done poorly because the Fed was hiking. But again, when the Fed is going to wimp out, I think that real estate is going to outperform equities because of the nature of being a fixed supply kind of asset, at least in the short run. The only caveat is that a lot of real estate is going to be stranded because of global climate change.
Stagflation already seems like the nightmare scenario for central banks if you have high prices and lower growth. But if you tack onto that a debt crisis plus stagflation, that just seems like incredibly difficult for any central bank to navigate.
I'm going home. Okay, just under 4 minutes away from the opening bell, and I mean MSCI China's there, Hang Seng Tech Index is there, Hang Seng China's there, and it looks like the Hang Seng Index is going to follow suit. We are on track there to enter a correction if nothing changes as these.
Yeah, we thought we were getting there yesterday.
Yeah.
I think they were just waiting for you to come back.
Maybe it's a Thursday thing.
I don't know.
Yeah.
But yes, we have earnings to deal with as well.
Yeah.
Tech route, Baidu, inflation numbers out of Hong Kong, and it's really about earnings.
Welcome back to Bloomberg Daybreak Europe. Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg.
Good Thursday morning from Hong Kong. So a couple of things on the agenda as it pertains to Chinese markets. So you have inflation coming out of Hong Kong, number one. Number two is this tech rout, which seems to be continuing. Number three is earnings, and hopefully that could affirm what's taking place, this reopening story, and hopefully could inform us about what's ahead, and we'll have to wait for guidance on what these companies say, Yvonne.
Yeah, because, we're not going to get any data until March, right? We have the MPC that's still about 2 weeks away, so we're kind of in this kind of holding pattern about what next and what really is going to take us a little bit higher or even lower, right? So earnings are certainly going to be key. It seems like the tech route certainly is kind of dampening the mood when it comes to the likes of Baidu and Alibaba that's coming up later on here today. But the Fed discussion continues to really charge on how much higher these rates can go, right? They're talking about, 5.4% for a peak rate that traders are pricing in. The possibility of that June hike is near basically a certainty right now. So the market's still kind of in a reality check about that. So that certainly is impacting the likes of Hong Kong. Here's how the Shanghai markets are looking at, and we're still seeing a little bit of green, but we're basically flat in Shanghai as well as in Shenzhen here today. We talked about the dollar moves as well in the back of those Fed minutes. It wasn't anything earth-shattering new, but certainly did kind of confirm that the Fed's not quite done yet when it comes to fighting inflation. So is that sort of pivot trade continue to be priced out here, going to continue here? You're seeing rates at 291 for your China 10-year. Shanghai crude really following the moves that we saw in WTI, basically holding the longest losing streak this year for crude markets in the U.S. And take a look at how Hong Kong is. You're seeing marginal declines across the board here, 1/3% lower. We'll see if we get into that correction territory. We were set for that yesterday, as Dave had mentioned, right? MSCI China, HS Tech, HSCEI already there. Baidu, there you go, 3% drop here as well on the back of those earnings, despite the fact that they unveiled this $5 billion buyback. Sales also beat expectations, but still, this rally, Baidu is the best performing stock we've seen this year, Dave, on the HS Tech index. So we're trimming a little bit this rally here, especially given what we saw with people really chasing that whole AI sort of frenzy here. Alibaba's coming up next. You have NetEase as well, and we have plenty of other earnings to tell you about. Hong Kong Exchange, the property developers like Sonongkai, as well as New World here. It'll be interesting to see what they say about this whole stamp duty thing that they announced during that budget as well, that cut there. And Galaxy Entertainment, we're looking at a little bit more at Macau casinos, and that's just not it. We have a lot more other ones to deal with here as well. But the final roundup here in Hong Kong, Dave.
Absolutely. There we go. Our next guest actually thinks that this rally is not done. Maybe the easy money's been made, and then this rally turns a bit more structural, if you will, in the offshore market, and maybe use this recent drop as perhaps an opportunity to bottom fish. Let's bring in our next guest, joining us out of Beijing, Kevin Liu, Managing Director Strategist at CICC Research. Kevin, good morning. I just wanted to get your sense so far of what you make of the earnings season and whether or not anything stands out to you at this point.
Well, earnings season definitely is an important part of the market, especially when the market recently pulled back a little bit from this peak, and also, a little bit directionless because the market running the expectation and they want to do a reality check to pause a little bit. So earnings season, we expect, it's pretty much priced in of the decline last year, but investor will looking for forward-looking clue for potential, improvement in certain sectors. For example, companies' management guidance regarding consumption, regarding their confidence in future investment. That will be the key to drive the market performance.
And has, what's the tech route telling you though, right? The fact that they're, people are starting to think they're emerging out of this regulatory crackdown, and now they have to focus on the domestic side of the business, which basically means more price wars, cash burn, the like. Do you think the market is overreacting to these sort of concerns, or is it really time to take some profits out of Chinese tech?
Well, overall, our sector recommendation is that we think 2023 will be a turnaround year for tech, internet, and also select healthcare sectors. Those kind of a tech rod and also those pressure you mentioned is not a new story. It's kind of being there for a while. But I think right now what the market try to price in is, how much upside and its downside try to be a tug of war to drive the market performance. yes, after recent quick rally, it has priced in a lot of improvement expectation, but I think it's not over yet because first, you're already seeing the inflection point in earnings. Secondly, it is very sensitive to global liquidity condition. And thirdly, as per our estimates, we believe 2019, which the moderate economy recovery and accordingly structural market performance will be our best case scenario. In this kind of a market environment, those growth names will actually be better choices for the investors.
Understood. So Kevin, Goldman Sachs came out with a note, I think it was early this week. After the rally in MSCI China, they think another 25% is ahead. What do you guys think?
We estimate roughly 6 to 10% earnings growth. I mean, for now, given what we see, depending on future policy, especially I will watch very closely on the property market policy, which I believe is the game changer. And right now, the valuation is almost back to its long-term average, but we still believe like 5 to 10%. So I would say like 15%, something like that, for the index upside. So this recent pullback is really, I think, provide opportunity for investors to re-entry. It's kind of a good window for investors to try to bet on future rally.
You mentioned the policy measures of the housing market as a game changer. It's really mostly catered towards and targeted towards the developers, right? And really making sure liquidity is there at the moment and the like. In terms of demand and stoking that, we haven't quite seen that yet from policymakers yet, too. Kevin, do you think that is the missing kind of link here for the housing market to recover and for these markets to actually resume itself, this rally?
Well, physical market and stock market is a little bit different thing.
Sure.
The reason I say physical property market is the game changer because if only rely on consumption, well, yes, the economy will recover, but it's not going to be that strong recovery. The number just cannot add up. But if we want to expect the property market to recover, it's most likely to be from the higher tier cities because lower tier cities already exhausted its potential room. But in order for higher tier cities to see more upward trend, we have to see price hike expectation, and also more importantly, we have to see more cities to introduce relaxation on purchase restriction. That will be the leading indicator and most important factor I will watch for. But for the stock market, it's total different story. The MSCI China property sector has rebounded from 0.5 price to book ratio all the way to 0.8, but stopped there for a couple months. It's waiting for demand side policy. But we still suggest investor can bet on it, including its value chain, because the downside risk is potentially limited, but you can bet on potential policy support. That's kind of a rationale we recommend it.
Okay, I think the whole debate about A versus H shares as well. I think, back half of last year was H, and now everyone's saying, look, I think that's gone too far. I'm focusing more on the A side. Where are you on this debate?
Well, for the A-share market, I think, in our central case scenario, if it is the 2019, which means it will be a structural opportunity, the economy recover, but only moderately, A-share on the index level will probably outperform H. But I still have to do one check regarding the policy, especially the property market policy. If we expect policy to be much stronger than we expected, which we can see after annuitization around April, we can switch to the bull case, which is 2017 as a reference. And in that case, H-share market.
Interesting.
Yeah, okay. That means we'll speak in April, and we'll see which of your scenarios is right. Kevin, thank you so much. Have a good time in Beijing today. Kevin Liu, Managing Director, Strategist at CICC Research. As we were having that conversation, more details from the BOK statement is now out. Just keep in mind they left rates unchanged and could be the last one. Well, the last hike was the last meeting. 3.5%. The current stance is restrictive enough and is warranted for a considerable amount of time, perhaps them alluding to the fact that, yep, they're done, but they are nowhere near even thinking about cutting interest rates.
That's the thing, right? They're pausing, but they could pause for a long time and hold there. So that's the key question.
Yeah.
What does considerable time mean?
Yeah.
And what would warrant them to downshift to maybe either a slower pace of hikes or even just cuts in general? Certainly what we're watching out for very closely. Inflation likely to fall slower than major nations. But they mentioned about China. They mentioned about this tech recovery as well, expected to help the economy from the second half. All right, more from that coming up. In the meantime, let's get you caught up with the first word news. Federal Reserve officials anticipate more rate hikes to curb inflation, though most support slowing down the pace. Minutes from the Fed's meeting 3 weeks ago say almost all officials agreed to an increase of 25 basis points. Only a few were said to have supported a 50-point hike. A number of officials said an insufficiently restrictive policy stance could stall progress on moderating inflation. Bloomberg has learned that Chinese authorities want state-owned enterprises to phase out using the 4 biggest international accounting firms. This signals continued concerns about data security, even after Beijing reached a landmark deal to allow U.S. audit inspections on hundreds of U.S.-listed Chinese companies. No deadline has been set for the changes, which may happen gradually as contracts expire. The Bank for International Settlements says fiat currencies have